Today, folks, something incredible has happened since September, and that is I've finally been investing in the stock market now for just over 8 years, and kind of coming up on that 8 year, incredible milestone. I wanted to share with you the cumulative performance of my primary investment accounts to show you how much I am down, and something many YouTubers will not share with you. And I'm not going to be doing this as something as a brag because the performance over the 8 years has been still relatively resilient against the indexes, but I want to do it to framework what I'm going to be doing moving forward, coming from the experience of the past, what I see happening in the present. And many of you know I have been investing pretty heavily in the market over the last week. I mean, I dumped just about $10,000 in, and I still got about another five that I'm looking to allocate. And I'm going to talk about some of the strategies and looking for more growth prospects. As I primarily pulled back from a lot of the growth positions I had and moved more into kind of passive index funds that offer some pretty decent dividend income along with some REITs. But without further ado here, folks, let's just jump into this by taking a look at, first and foremost, when you take a look at the top left here, guys, you're going to see the things that I've scratched out representing just the account numbers, but we can see my TFSA, my cash account, my RRSP represented against the performance of the S&P 500 and the S&P TSX. Now, over this 8 years, the S&P TSX is only up 18%, and the S&P 500 is only up 78.98% currently. And again, this data only comes in to the end of September here. We do obviously not have the volatility that's been coming in the following month, but nonetheless here, folks, my TFSA, dividends included, a cumulative return sits at 124.17%, represented by the blue line. We can see that my managed account, the cash account, my longest standing account, the first one I started, is up still 262.87% and is actually seeing the largest decline, primarily because I still hold individual stocks in that account like REITs that are seeing a much heavier decline than the indexes. We've got Scotia iTrade, my RRSP account, that is up 218%, probably my best standing and performing account because this account was only started in 2019 and it has outperformed pretty much all my other accounts, but that was primarily driven from Tesla that I did pivot into a lot of dividend indexes like SCHD along with VYM. So it's incredible to see the stellar performance of just, steadiness investing. I do not do a lot of trading. Many of you know I'm primarily a swing trade investor. I'd say I buy positions, I'll hold them for a few years. If things start giving me excessive returns, I diversify those returns into other stocks, but again, primarily being index funds these days. But I am not looking to be primarily just in index funds. Even though that's where I've been putting the vast majority of my recent money, I am still looking for growth prospects moving forward. And I want to talk about those growth prospects. But the first thing I want to discuss here, guys, is kind of the delusion that we're constantly being fed right now, which is the endless fear. It doesn't matter how bullish I could be on the market. It's going to get shot down 9 ways to hell. I mean, it's just insane to me that, this market has become the most negative thing I've seen, which is, again, works out to being an incredible buying opportunity. I'm going to explain to you why I still think it is probably an incredible buying opportunity. And that comes down to the fact that everything in the market seems to be driven from the inflation data. But the inflation data, I still don't think comes in as accurately or should be represented the way the Fed represents it, which is over a 12-month trailing period. Because over a 12-month trailing period, you have to imagine that basically if we had a higher period of inflation back in October of last year and we roll over a month, you're still going to see a higher annual inflation rate. But the fact of the matter is if we took the annual rate starting from July, we're actually at a nominal 2% inflation rate. And yes, the last inflation numbers that came out today were 0.4% for the month, which is a lot higher than I'd like to see it because annualized, it's about a 4.8% inflation rate. But if we can keep hovering between a 0.1 and a 0.4, and we start averaging hopefully between a 0.2 and a 0.3, we are right now at a nominal level of inflation. But again, you're not going to see that get represented in the 12-month trailing until we start coming into about January, February, and it'll really start rolling off come into April and May. So we're going to keep hearing these inflation stories for the foreseeable latter half of this year, which again, I think the markets are kind of getting exhausted by this news driving the stock market data. Because again, let me just pull up something today, is if you read the news on the market today, something tells me that you would have been relatively devastated, right? I mean, let me just show you this, guys, because if we go into the, my watch list here on StockTwits, everyone this morning was complaining in the chat group. Everyone is losing their minds that the market was tanking. And then sure enough, that $10,000 that I invested over the last week is now green after going pretty negative this morning. I mean, we're taking a look at all of these stocks rallying so aggressively again, off what was an initial bad, CPI data. And I don't know what would be making the market shift so dramatically here, but take a look at this. I mean, VYM's up 2%, SCHD, the Qs are up 1.5%. It looks like everything just flipped to the green. And inevitably, people are going to get burnt out from constantly selling off into this negative Nancy kind of news, right? Like this news can really only deflate the market to a certain level. And then again, you're going to get more people like myself that are just going to continue buying it. So before I tell you what I am most intrigued to buy, because obviously I already have a lot of VOO, I'm already largely exposed to indexes. I keep cost averaging, but I do want to take a larger growth trajectory here with some pretty extreme stocks that I haven't had the guts to buy just yet. But before we do that, I just also want to show you that I always love pulling up the VOO ticker symbol and just taking a look at what it's doing, because we can see here comes in the inflation data. The market drops miserably, and now we're up higher than we have been over the last week. But when you scroll down, guys, and you just look at the news, it's just endless. Dow Jones dives 500 points on hot inflation report. 10-year Treasury yield tops 4%. Late slide sends Wall Street lower in more uncertain trading. Euro and pound ease CPI declines. Now, the global uncertainty also has other impacts. I'm speculating here, obviously, right? I mean, there's going to be a lot of black swan events going on globally that could still impact our economy, but I'm primarily just paying attention to the Western world and kind of what I see going on, considering we just saw OPEC, they did their meeting. They're trying to raise the oil prices, speculatively, and that could also drive inflation, and that could also be seen as an attack against the West. But then they're also saying that, they have their own concerns with inflation out of control. They need more money. So a lot of the oil-driven economies still want a higher oil price. All of that is purely speculative by nature, and all of that could lead to further sell-offs in the market. But inevitably, we're going to hit lows where the market, especially in the Western world, it's going to hit a bottom inevitably. And when it starts turning around, it doesn't matter how negative everyone's going to want to be. It won't matter, because eventually news stops moving the market cycles because things have just hit their bottoms, right? So a lot of people are predicting the market can still drop 20%. Is that a possibility? Absolutely. Do I believe it's going to happen? I have a hard time believing it's going to happen from here. And again, I can point out a bunch of positive reasons that I think it's not going to happen. I think it's going to happen, but we're kind of in that two-edged stream where when you look at the data, until jobs start really getting hit, other, pressures really hit the market. And, maybe we start seeing real estate get hit harder. All of that still, if the harder real estate gets hit, the harder assets get hit, the more it's going to bring inflation down. So from an inflationary standpoint, that is inevitably going to come to an end. So you're going to have to look at the other end of it, at what's going to hit the market. And it can only really comes from jobs, foreign exposure, maybe speculatively oil and everything just jumps crazy again, and we see inflation get out of control. But I don't know. I just feel like the negativity at this point is at a part where not only is the market at fair value, the indexes, but if you're buying individual stocks, you're looking at extreme discounts across the spectrum. Like, I am heavily analyzing things like REITs, MPW right now, a lot of the utilities, growth stocks. I mean, you're looking at things like Shopify and Facebook just trading at absolute ridiculous lows, where you're starting to see that there's just excessive value for these companies investing heavily into what in the next 2, 3, 5 years is going to offer a lot of growth vectors. I mean, especially with Google investing heavily, Tesla's investing heavily, Shopify, they dump billions into their e-commerce, warehousing. I mean, you're just seeing all this investment capital from companies that don't have any debt. I mean, Google can pay off their debt tomorrow. I mean, you're looking at Apple. I don't know. I think Apple still, Microsoft could move the market because they're probably one of more of the premium valued stocks, but you're just looking at companies that are investing so heavily into their future that aren't affected by interest rates and are only largely affected by one thing moving forward. And that is consumer spending, right? Because as interest rates go up, people get a little bit more skittish. So the next big factor that is kind of holding me off from doing any growth investing is earnings. And when we get through earnings at the end of this, a lot of people are projecting, a lot of fund managers I watch, a lot of the Meet Kevin fund managers, those kind of guys, they're all thinking that we're going to have a better earnings than probably most anticipated, primarily based off the last earnings we had. But presuming these earnings aren't absolutely devastating and we're still seeing kind of nominal growth, which growth has slowed down because of lack of consumer spending and marketing and all this stuff, inevitably that's going to shift. I don't know when. It could be 3, 6, 12 months from now, but that's going to come back to a nominal rate. And I'm expecting that we're going to see the bottoms of growth rates come in and probably between last quarter and the end of this year. So presuming that we're kind of just seeing still growth rates, we don't see negative revenue growth out of these conglomerates like Google, I can't help but see why they're not probably a screaming buying opportunity. So one of the stocks that I'm looking at that I've talked about many times in the past is TQQQ. I have not had the guts to buy this thing. primarily because I just haven't had a feel out enough for it, that the markets have come down to their, their last gasp of insanity. And obviously this would come with excessive speculative risk. But when you look at the companies that TQQQ is primarily invested in, which is again represented from QQQ, the Invesco, ETF, that kind of just top weights a lot of those great tech companies like Apple, Microsoft, Amazon, Google, Tesla. It still holds Facebook. It's got PayPal in there. You got Costco and Pepsi, some really great foundational consumer staple brands. And I'm just looking at this and saying, look, if I believe, for me personally, I'm not offering this as investment advice, but if I believe that we're going to start seeing the market stress out its bottoms here, and that we're going to start seeing limited downside coming after this earnings period into the latter half of this year, and presuming this earnings period is not as terrible as a lot of people are expecting it to be, and if I get the right feeling and the gauge out for those earning numbers as they come in, which I will share on this channel, obviously, I will seriously consider taking out a position at that point in TQQQ, because I think coming into probably summer of next year to the latter half of next year is when we could start seeing somewhat of a return in the rally, because again, the market will inevitably nominalize. Earnings rates might not go back to where they were prior, but I still think they're going to end up higher than where we're sitting, because consumer spending will become more confident. Consumers have higher savings in their bank accounts than historically. There's just a lot of variables, right? So this would be the position that I'm primarily going to be watching closely. And again, I don't care if it bounces back. If some good news comes out and the market jumps 10, 20, 30% in individual stocks like Facebook or whatever, you don't have to catch the bottoms here. You can also start buying the rally back. It's not like you have to be super aggressive with it, right? But I just want to pay attention to this, because I think the best rate of return for me getting my accounts back to, recent highs is going to require some growth vectors that I have absolutely zero exposure to. And my best growth company right now is basically the S&P 500 index. And that's not something that I want at my age of 30 years old. I still have 30 years of investing ahead of me. I have a lot of opportunity to take on higher risk. This is just not a high risk market, and you have to be very careful about how you go about doing it. And because I sold off all of my growth stocks, Facebook, all of those companies in the first quarter of this year, it has saved me an insane amount of gains and losses. So at this point, I'm still losing money, but I put it mostly into these really passive index funds that are luckily not nearly as down as much as something like Facebook. And I feel at this point is the time and the opportunity to start paying attention to those investments and start buying back into them. People have to understand that I don't recommend doing what I'm doing here. I mean, a lot of my family would rather just hold through these cycles. You don't have to trade in and out of stocks. I don't consider myself a trader as much as I just do swing trades, and I mostly just look for passive long-term investments. And I still believe Facebook is a great long-term investment. If you haven't sold out of those kind of companies, this is your opportunity to continue to cost average into those. However, for me, because I'm trying to outperform the market, and there's no point doing what I'm doing unless you're getting a higher than average rate of return, you have to kind of understand, and I'll state this for newer investors as well. When I started investing, I made about a 3-year plan. And I said, basically, if I am underperforming the indexes in about 3 or 4 years, I am no longer going to be buying individual stocks. Sometimes you have to wake up to the reality that if you're not very good at putting effort into getting a higher than average return from the market, but you're doing all this work, all this studying, buying all these individual stocks, you're better off just buying index funds. And it's a sad reality for a lot of people to wake up to, but a lot of people might have only been in the market for the last year or two, and they might be thinking to themselves, hey, I'm getting devastated. This sucks. I'm out, all this stuff. But you got to remember, in the first year and a half of my investing journey, my portfolio dropped 40% and I didn't see a dime of return. This isn't something that happens overnight. Some of you guys have to just learn to be super patient. And if you're being diligent, again, give yourself that 3 to 5 year time horizon. Pick the strategy that works with you, find your way into the market, and just play it out over time, because you're going to have to see how it works through market cycles. Now, obviously, if you thought gambling on crypto and highly speculative investments was the right idea, I mean, this has been that rude wake-up call that, you really need to learn to average out your portfolio and make higher speculative investments no more than 3 to 5%. So I feel like, a lot of those guys are wiped out at this point. We've seen the leverage unwind. I think we're coming out to the other eye of the hurricane here, and now we're going to get into the latter half of what this inflationary cycle is going to be. Again, I don't know if this lasts 3, 6, or 12 months, but I know we're getting to the latter half of it. And usually the stock market will bottom long before we see the latter half of the recessionary cycle. And that's just historical data, right? Like, the market bottoms usually before we really get any of the real recessionary data, and the market starts rallying back long before recession's even over. So you kind of got to figure out where that's going to get priced in and just allocate accordingly. And again, don't get me wrong, I want growth vectors in my portfolio, but I'm also buying not bonds, but guaranteed investment certificates. I opened up GIC accounts for my corporation. I am now socking a lot of my tax money into GICs, a little bit extra with my emergency fund. So I am balancing the portfolio out to get some stability, again, still through these tumultuous times. But again, you kind of just got to play it out. I'd love to know what you guys think about all of this in that comment section below. This is a really quick update video giving you guys some clerical insight into stuff that I know many YouTubers do not have the guts to show you. And I really appreciate the YouTubers out there that are kind of, offering people solitude, cost average investing strategies through these tumultuous times, because I think there's too much negativity. There's too much fear, and fear mongering only leads to discounts. And you have to be able and have the stomach to take the willingness to buy those discounts when those opportunities present them to you. So I hope you're continuing to buy. Like I said, I've dumped over $10,000 in the market in the last week, and I'm looking to still continue with the extra $10,000 I have left over to continue investing over by the end of this month once we get through earnings. So stay cool, stay awesome, folks. And as always, I look forward to catching you in the next one.